I think we've come time here where you've teed it up a little bit. Coming back to my hometown here of Chicago and the Cubs. What happened with Tribune Company versus the commission? I have to say, because I'll pause here and say this. Actually, this and the next case, when reading them through the year, in cases in general, I think, I wonder if this is going to make Tony's list. And I was like, yeah, I have a feeling this one's going to make it. So yeah, what happened and why is it important?
I'd be lying if I didn't say to you, listen, I'd love to have left this off the list because it's a pain in the butt case.
Sure.
It's complicated stuff. You're talking about nearly $1 billion changing hands. It's a 70-page read, but we've been waiting for this case for a while. Ever since Canal Corporation came out and really drew attention to leverage partnerships, we've been eager to see how this would go. And then the fact that it ends up being a split decision is kind of fascinating as well. And I know that we're going to get a little bit into the weeds here with partnership law, but we'll keep the sports fans. We'll lose the people that hate Subchapter K. We'll have a healthy mix here. We'll see how it goes. But
right.
It's fascinating stuff, right? Because what have we been talking about here today? We've been saying you do 1031 exchanges, exchange property for property, no cash. Okay, that'll be tax deferred. Why? Because you haven't cashed out your investment. You just changed the form. It's a statutory concession. All right. We talked about 1202 being a rarity in the law where you can have cash and not pay tax. But what we talk about here is the fact that everybody wants that. Everybody wants cash, at least without current taxation. And sometimes if you really dissect the law and have smart people at the helm, right, you can make it happen, at least to some degree. Now, this is 2 consecutive cases, big cases, $700 million plus, where things have not worked out perfectly with the taxpayer, despite having the best, the best advice from the best tax firms. But let's talk about what's going on here with the Cubs, right? So the Tribune Company, the media company, owned the Chicago Cubs. And they went through some hard times. They went through bankruptcy, but it's critical to understand that you can go through bankruptcy and still have plenty of assets on hand. And that was the case here. And that's a critical distinction when we compare it to the Canal Corporation case. So Tribune was going through some tough times, was in a bankruptcy, had plenty of assets, but decided it was time to sell the Chicago Cubs. And they, went through a long process and eventually identified the Ricketts family as being the buyers that they wanted to kind of get engaged with here. So think about it. Let's just talk simple numbers, right? The Cubs didn't have much in the way of basis to Tribune Company. I mean, these aren't the exact numbers, but we're just going to ballpark them for our purposes. Let's call that basis $5 million, okay? The thing is, the Cubs were worth $735 million. So if I own the Cubs and I say to Damien, hey, pay me $735 million in cash today, I'm going to have a tax bill, if my basis is $5 million, on $730 million of gain. That is not going to be an acceptable result to any savvy, sophisticated person, because they're going to say, I'd rather pay someone else to figure out how to get me out of the tax bill than pay the actual tax bill. But you can't have your cake and eat it too in the tax world. You can't have cash and not pay tax, or can you? Well, here's how they try to set it up, okay? And it's called a leverage partnership. And if I could geek out, I'd be drawing stuff for you right now. But you've got Tribune, and they take the whole Cubs assets, everything they got, right? I don't even know who the Cubs assets are anymore. They gutted everything. Baez's gone, and Bryant's gone. Who's left?
It's rebuilding here, Tony. It's a rebuilding.
Yeah, I mean, again, they pretty much gutted everything there.
Pretty much, yeah.
So they drop those Cubs assets into a partnership. And remember that the Cubs assets are worth $735 million, but they only have a basis of $5 million. So under Section 722, you drop something with a basis of $5 million into a partnership, your basis in the partnership interest becomes $5 million. Okay, fair enough. Then the Ricketts family puts in $150 million of cash. And you're like, all right, well, that ain't going to do us a whole lot of good because the Cubs are worth $735 million. We want $735 million. Why is the Ricketts family only putting in $150 million? Here's what's even weirder. You put in the Cubs for $735 million, Ricketts put in $150 million, but the ownership percentages say Ricketts own 95%, right? Tribune owns 5%. Well, how can that be if Tribune put in Cubs worth 735 and Ricketts put in 150 million? Because the plan all along was that cash was going to come into the partnership and immediately go out to Tribune to dilute their interest. But where is that cash going to come from? It comes from two sources, and both of them are critical in this case. First, they go out and borrow $425 million from a bank. Okay. And the bank's not messing around here. Like they said, hey, right, there's a waterfall deal in the partnership agreement that makes sure we get paid first, and we have priority over any other debts you take on. And, basically, again, we have all priority. We come in front of anybody. And more importantly, we're going to need a guarantee from somebody on this. But this isn't a problem. In fact, this is exactly what they wanted. This is what they designed. And we'll get into that, okay, in a minute. And so we got $425 million coming from a bank, and then we had $250 million loaned up from an affiliate of the Ricketts family. So it wasn't directly from the Ricketts partner, but from an affiliate. And this debt couldn't have been more highly subordinated, right? They couldn't come after the partnership until all sorts of avenues were exhausted. This debt couldn't even be paid until the first debt was paid off. The maturity date was subject to the maturity date of the first date. So in any way you could possibly subordinate this second affiliated debt from the Ricketts family, it was subordinated. But then what was even more interesting is we knew that cash was going to come out of the partnership and go to Tribune right away. And we knew we were going to end up with this 95-5 split with Ricketts owning 95. But the only way they could get to a true 95-5 split mathematically, and this was an egregious error by the lawyers if you ask me, is if that $250 million the Ricketts family put in was really representative of equity and not debt, right? Only by making that part of their capital would the percentages work. And that becomes very, very critical. So now, Damien, there's $675 million of debt at this partnership. And this is exactly done by design, because now what's going to happen is Tribune is going to guarantee both debts. And they're going to say, hey, if the partnership doesn't pay it, we will pay the debt. Why? Well, we'll get to that in just a minute, right? But they do that. They guarantee it. They have the assets necessary to pay it, because even though they're in bankruptcy, they've got over $1 billion in assets. But they go ahead and they guarantee the debts. Why? How does this all fit together? Okay. So what's going to happen now is, now that this cash is inside the partnership, they are immediately going to take $705 million of cash. So 675 of the loan plus an extra 30 of the 150 million, and distribute it out to Tribune. So let's just think about what really happened here. Tribune put assets with a basis of $5 million into a partnership, and the next day got $705 million of cash. What does that look and sound and smell like to you? A sale, right?
Sure does. Maybe in disguise, but certainly sounds like one to me.
So it is a disguised sale under the partnership rules, right? A 707. They say, look, if you transfer appreciated property to a partnership and within a 7-year window get back cash or other distribution of property, it looks and smells and sounds like a sale, so we're going to tax it like a sale. So if we stopped right there, they would be treated as if they sold assets with a $5 million basis for $705 million, right? And they'd have whatever that is, $675 million a gain to deal with, okay? But this is where the savvy attorneys and tax people are so valuable. They kick in and they read the regulations 707 and 737, and they say, wait a minute. If a distribution is what we call a debt finance distribution. So a distribution comes out of a borrowing and it's going to the party to whom that debt is allocated under the partnership rules. Then that piece of the cash that changes hands will not be considered proceeds in a disguised sale. And so what's critical here is under the partnership rules of Section 752, when the partnership borrowed $670 million, where should that have been allocated? We all know we allocate liabilities under the partnership rules. We all know that the K1s say who gets what piece of recourse, non-recourse debt. And we all, normally we would say, well, wait a minute. If Tribune family guaranteed all the debt, then they bear what we call the economic risk of loss under 752. They would have to pay the debt if it goes bad. And so we'll allocate it to them. And that's what they did. So by allocating the $670 million of debt to Tribune and by distributing the $670 million of debt to Tribune, that debt is removed from the disguised sale rules. So Tribune said, yeah, we did have a disguised sale. We sold $5 million basis Cubs for $705 million less $670 million of debt finance distribution that's removed. So $35 million of proceeds, $5 million of basis. We'll pay tax on $30 million of gain. We also got $670 million of cash in the coffers. We're just going to ignore that for now. Now, again, it's a deferral because when you take the distribution of your debt financed proceeds, you had a basis in that $670 million of debt that went down by the distribution. So when you now repay the debt, you'll recognize the gain. But the point is, you got $670 million of cash and you control the timing of when you recognize the underlying gain. That's a pretty nice gig if you can get it. So what we had here was we knew for years that the IRS had challenged this sale as being abusive and that Tribune shouldn't have been able to use the debt finance distribution. We knew they were going to come after them and say, you should have picked up that extra $670 million as gain. And that's exactly what they did. And the IRS made two competing arguments, okay? Number one, the debt from the Ricketts family affiliate for whatever that ended up being, $250 million or whatever it was. They said, and this is fascinating because I didn't know the case was going to go this way. They said, forget the analysis of whether the debt should be allocated to you or anything like that. We don't actually think it's debt. We think it's equity under debt versus equity principles. Now, I don't know if we covered, I think we might have covered the other direction, whether, distribute dividends or salaries, but anytime you make a purported advance to a business, it could be debt, it could be equity, right? And we have factors that tell us. And depending on what circuit you're in, is going to drive which factors they look at. But, they'll look certainly at the formal indicia of the debt. If you don't have an interest rate and a maturity date, that is not going to look good. Now, in this case, they had an interest rate, but the maturity date was dependent on the maturity date of the bank debt. And so it wasn't fixed in time. That is not a good factor. Another very bad factor for Tribune was the fact that it was so heavily subordinated to the bank debt, right? The agreement made it very clear that all the bank debt had to be paid and only leftover money could be used to pay this second debt. That makes it smell and sound more like equity. One of the biggest factors was what I said to you. Only by treating it as equity would the percentage ownerships fit 95 and 5. If you treated it as debt, it was more like 86 and 14. Whereas if you treated it as equity, it was 95-5. That was not a good look at all. And then they will also look at your use of the funds. And if you put money into a company that's immediately used to acquire assets, the courts over the years have said that looks more like equity than debt. So long story short, they kicked the tires on the different factors here used in the relevant circuit, and they said, we think this is equity, not debt at all. And so if it's equity, you can't use the debt finance distribution exception. That's $250 million of cash that went out to you that is now additional gain. So that's $250 million right off the bat that Tribune Company has to pay additional tax on. So they lose on that side, right?
Right.
Then,
whew, man, like you said, there's a lot to this one. You got to unpack it, you know?
no, and we're only scratching the surface.
I know. You almost see like a seventh inning stretch or something if you're going to throw in a baseball metaphor here or something. Because it's just, man, it's there's a lot.
Yeah, but we've been waiting for this one for a long time, and it's because of the second challenge. The second challenge is the IRS came in and said the 425 million of bank debt. This should not have been allocated to Tribune under the 752 rules for a variety of reasons. Number one, they said they don't actually bear the risk of loss if the LLC doesn't pay it. Number two, they argued that the guarantee was so contingent they would never have to pay it because the lender had to really, really pursue a bunch of legal remedies against the LLC before they could go after Tribune. Then they argued that they didn't have enough assets to pay it if they were called upon to pay it because they were in bankruptcy. And finally, they referenced a bunch of broad anti-abuse rules in the partnership regs, right? Now, the reason they launched this attack is because we had an unbelievable case that at this point might have been 5 years ago. I don't even remember. But Canal Corporation. Same exact basic structure, Damien. Somebody wanted to sell a tissue business of all things for like $750 million. Who knew, right? And they did the same thing. They put the business into a partnership. Somebody else put some cash in. They borrowed a bunch of money and they distributed it out to the seller. But in Canal Corporation, the seller had distributed all of its assets to its owners, so it had no assets left, and it didn't actually guarantee the debt. It provided an indemnity in case the primary guarantor didn't cover the debt. And what happened in that case is the court went in and looked at it and said, you know, it's an indemnity, it's not a guarantee, and it's meaningless because even if you were called upon to pay it, you don't have the money to pay it, right? And so what's remarkable is, again, without signing blame here, they had an opinion letter from a Big Four accounting firm that transaction would work, and it did not work. And when you talk about interest and penalties on $700 million of gain, it's hefty, right? Really, really hefty. And so Canal Corporation was problematic enough that they wanted to revamp the 752 regs, and they did draft those regs, but they ended up getting nixed by the Trump era reduction in regulation kind of requirement. But they would have put a lot more requirements on guarantors to get debt allocated to them under the partnership rules. But coming back to the Cubs, they launched very similar attacks on the Cubs and tried to draw a parallel to Canal Corporation. But in this situation, we found that the advisors for the Cubs did things right for this $425 million of debt. It wasn't simply an indemnity. It was a guarantee. And even though they were in bankruptcy, they had $1 billion of assets they could have used if they were called upon to pay the guarantee. And yes, there were a host of provisions requiring the lender to go after the partnership. But what they look at to see if you should be allocated recourse debt is a worst case scenario where every asset of the partnership goes valueless, is sold, and the liability becomes due and payable. Who has to buck up for it? And in this case, they said it's very clear based on the documentation. It's not the Ricketts family, it's Tribune. Tribune would have to pay this, right? And then they drew this other distinction, which I kind of find interesting. I know I'm getting into the weeds, but in the Canal Corporation case, if the party had actually paid the guarantee, they would have gotten an increased ownership interest in the partnership. That's a bad look. In the Cubs case, if they paid the guarantee, their interest didn't go anywhere. And so they tried to make some anti-abuse claims. They tried to argue that it wasn't a real guarantee. It didn't impact Tribune in any way, but it affected their credit rating, right? It had a real impact. It was presented on their financial statements, albeit in a small way. And so long story short, the court came out and said, unlike Canal Corporation, Cubby's, Tribune, this $425 million of bank debt, it was right to be allocated to you. It stands up as a debt finance distribution. And so you don't have disguised sale proceeds for that $425 million. You do for the $250 million of Ricketts debt, but not the $450. So it was $425, whatever it was. So it was a split decision, right? Split decision. They lost the $250. They won the $425. We'll see where it goes from here. What I would love, and I haven't, undertaken this just yet, is for someone who knows Subchapter K better than me to go back and read the proposed 752 regs that had come out and said, okay, let's take these Cubs facts now. And if these regs had been relevant at that time, would we have gotten a different result?
The same result.
Right? Let's look at the requirements for a guarantee and see how that would have worked and the debt finance distribution rules. But it's really amazing. I mean, it's amazing when you think about they were one small misstep in the debt equity analysis away from having $705 million in their pockets and only paying tax currently on $30 million. Now, eventually, like I said, you're going to pay the tax, right? Because once the liability gets paid off, then it's a deemed distribution. You got no basis. It all gets triggered, but you control that timing.
Yeah. Well, I mean, in the name of the game in tax planning is generally deferral, right? So, I mean, that's what we're trying to do here. Yeah, that would be a fascinating analysis to kind of compare. Because, I mean, I always find, and I'll get your take on this too, when you have things like proposed regulations that get put on the shelf and don't go anywhere, or even proposed legislation, I mean, it's fascinating because you never know when it might come back off the shelf or something, and what the viewpoint is that went into it.
Yeah, and is the government going to be angry enough about this split decision that there's a point of emphasis to get those 752 regs back? I don't really know. But yeah, we've been waiting a long time for this one, and it's not an easy read by any stretch. And I'm sitting there trying to do the math on, you have to kind of back into how they came up with because they acknowledged it was a disguised sale. They paid tax on $30 million. They just said that the other $670 million was covered by the debt finance distribution. So you're just trying to work through the math and figure it all out, and it's not actually as long as a read as I thought it would be. It's it's more like 70 pages, which is tolerable.
And still some heavy stuff in those 70 pages, perhaps. I guess in fairness of K, it's some heavy stuff. But
it's not. I mean, K is not for the faint of heart, man. And this is the worst part of the worst subchapter in the code.
Yeah.
Like 737 and 707. It's a mess.
Yeah. Well, worst or best, depending on your vantage point on the tax law, I guess.
Yeah, exactly. I think if you're Tribune Company, you're pretty happy with Subchapter K right now.